Welcome once again, ladies and gentlemen, to this wonderful section where this is an educational webinar where we want to look at the fundamental approach to Forex. Of course, the fundamental is actually what drives the market. Okay, market moves based on the fundamental. And so it is very paramount that you understand the underlying fundamental behind any market movement. When the fundamental is actually given, it will also drive market sentiment. And the sentiment will give directional bias in the market, and then the market moves based on the bias of the traders. So this is what we want to look at today on the fundamental approach to Forex. And this particular section or this particular webinar is presented to you by DB Investing. DB Investing is a global brand, and it's one of the best brokers you can ever use to actualize your dream. It gives you the best of spread, best of customer services. And if you actually want to do something substantial in the Forex industry, here is your opportunity to partner with DB Investing. So let's dive into our lecture for today, the fundamental approach to Forex. Okay, you're welcome once again on the fundamental approach to Forex. And this particular lecture is presented by my humble self, Mr. Shedrack. I am the financial analyst for DB Investing Nigeria. Of course, you will agree with me that after this lecture, your understanding of the fundamental, your scope in the market is going to be widened, and then you will see it at a broader perspective on how to benefit from the market using your fundamental announcement. So let's dive in. I wanted to stay put because this lecture is going to take a little time. Some time, let's put it that way. So, but it's going to be really expository. So I want you to stay put and then really benefit from this particular section. This is a section that a lot of people will pay heavily to learn, okay? But DB Investing is giving it out for free for you to actually learn, okay, on what actually moves the market and how you can benefit, okay, from the market, understanding the fundamentals that is actually possible. Thank you so very much. So let's push into this lecture. Okay. So let's go. So fundamental analysis, because your trading need to be empowered by data. So what exactly is fundamental analysis? You know, a lot of people know about the fundamental. And when they talk about the fundamental, what they basically think about is to go to their Forex factory and just to look at what is going on in the Forex factory. Okay, if the actual is better than the forecast, okay, good for currency. Okay, that is just what they know about the fundamental. So when you ask them, what is fundamental analysis? All they think about is, okay, let's go to Forex factory and maybe any other economic calendar. Yeah, it deals with the economic calendar, but do you actually know how to interpret this particular fundamental? So that is what we want to look at today. So fundamental analysis. Now, fundamental analysis actually, it is a way of judging or analyzing the market by looking at the economic, social, and geopolitical forces that may affect the supply and demand of an asset. Now, what does that mean? Is that before any fundamental announcement, there are movement in the market. There are economic factors, social factors, or political factors that can influence the behavior of the market. For instance, if there's an election in a particular country, whatever it is, or if there is any form of economic announcement, maybe the central bank of that country comes up to give any economic news as pertaining to the economy or their currency, on anything, probably if there is any geographical happening, maybe an earthquake or war or whatever, all of this can actually influence the behavior of a particular asset. And these are the things that actually moves the market. The president of a particular country, the speech of the president can actually influence the behavior of an asset. So fundamentally speaking, a lot of Forex traders or investors look at what is actually going on in regarding that particular asset they want to trade. What are the fundamentals, underlying fundamentals around it, and how they can use that underlying fundamental to depict or to detect the directional bias of that asset. So that is all, because it is the fundamental that is actually responsible for the market movement, because the fundamental gives rise to sentiment, market sentiment. And when market sentiment is established, a directional bias will evolve, and that will cause the movement in the market. So the fundamental analysis, therefore, is a way of judging the market by looking at economic factors, by looking at social factors, by looking at political factors that may affect the behavior of an asset. Okay, so when you look at that, with helped with your technical analysis, you can now decipher the directional bias in that market. Right, let's look at the next line of action. Now, in our bid to understand fundamental analysis, what do we actually look into? In our bid to understand fundamental analysis, one of the figure we have to pay attention to is the central bank, because actually it's the central bank of each nation that brings forth their fundamental reports at a duly date that people begin to look at in the Forex economic calendar. All right, so they bring forth this fundamental report, and there are different factors, different indicators that the central bank of each nation looks at to determine what kind of risk event they are going to bring up. So the central bank of a particular nation monitors various economic indicators. All right. So they come up with various economic indicators. All right. These are the economic indicators. And when they monitor these economic indicators, on the basis of the conclusion they get from the economic indicators, they will now decide on which particular monetary policy to implement. And the essence of doing all of this is to bring forth what is known, the ultimate goal of each central bank in any country is to bring forth economic stability. So when the economy of any nation is not stable, the people that are involved that are to be held responsible is the central bank. The central bank is actually an autonomous body. That's why we have the governor of the central bank. Okay, they bring forth these policies, and their policies is geared towards actually bringing forth stability in the economy. All right. Now, once they have monitored different indicators, and then they have come up with a particular policy of what they want to actually implement based on these conclusions they have derived from the indicators they are monitoring, they will now bring forth a fundamental announcement or a news report, which we will see in our economic calendar. And then when they now release that particular news report, the news report will drive market sentiment, which will definitely result in the movement you see in the market. So let's push on further, because this is an interesting class. If you understand the concept of fundamentals, you are going to actually benefit a lot and know how to maximize your profiting in the Forex market. So let's see further on this. Okay. Yeah. Now, Forex market. The Forex market is actually, if you got to understand the Forex market, then if you're an economics student, you understand that we talk about microeconomics and macroeconomics. Now, whenever we are looking at the overall economy, that case, we are talking about macroeconomics. Now, Forex, actually, the financial market, if you are dealing with the global financial market, we are actually dealing with macroeconomics. And in macroeconomics, we are looking at things like inflation or deflation, GDP, which we actually call growth, production. This falls in line with our production, manufacturing, PMIs, and the rest of them. Then we'll talk about employment, all right? So, and then we also look at non-economic factors, such as war, change in government, war, and the rest of them. So when it comes to the forex industry, we deal with macroeconomies. And these are the data or indicators we look at: inflation, GDP, production, employment, and non-economic factors. We are going to look at them one after the other. And that's why I said this is actually revelatory. It is something that you have to stay put, understand this concept, and then bring it in and see how it will boost your forex understanding of forex trading, your success rate in forex. Okay, so let's go. Now, in understanding economic indicators, there are majorly two types of economic indicators. Number one, we have the leading economic indicators. Number two, we have the lagging economic indicators. Now, the question is, what are leading economic indicators and what are lagging economic indicators? Now, let's go. Leading economic indicators, what are they? Now, leading economic indicators are variables that help us to predict the outcome of another economic variable. I will explain that. For instance, let's say you have retail sales. Retail sales is a leading economic indicator because we can use retail sales to forecast GDP. For instance, you must have heard about ADP. ADP is a leading economic indicator. Why? Because we can use ADP to forecast NFP. All right. So we have leading economic indicators. We also have lagging economic indicators. So what are lagging economic indicators? These are economic variables that are predictable. These are economic variables that we can predict using another economic variable. So these are called lagging economic variables. Now, don't be confused by the terminologies, because actually this has to do with microeconomics. So I have to use the language that is appropriate, okay? So I just wanted to step up because this is like a fundamental masterclass, right? Yeah, it's like a fundamental masterclass. So just stay put and then follow me. At the end of this lecture, you'll be glad that you stayed. Yeah, you'll be glad that you stayed. So let's push on further. So let's look at leading economic indicators. Yeah, leading indicators. Examples of leading indicators, we have the retail sales, we have the jobless claim. We are going to explain each of these ones. We have the purchasing managers index, we have the stock market, the yield curve, housing statistics, okay, and then the production price index or producers price index. Supposed to be producers price index. Sorry about that. Okay, so these are examples of leading indicators. Why do we call them leading indicators? Because we can use them to predict the outcome of another economic variable or another economic indicator. So since you can use them to predict, they are referred to as leading indicators. Is that okay? Now let's push on further. Lagging indicators. Examples of lagging indicators: we have balance of trade, we have unemployment rate, we have interest rate, consumers price index, CPI, and then we have the gross domestic product, which is the GDP. We are going to look at this stuff, these indicators, on like unemployment rate, interest rate, consumers price index, CPI, and then the gross domestic product, which is the GDP. This is it's a classic lecture you're receiving right now. This is something that DB Investing is giving out to you for free. All right. Of course, for you to have this kind of a classic lecture, you should pay for it. All right. You should pay for it. This is something that sometimes you pay heavily just to get this kind of a classic lecture. So I just want you to harness this particular opportunity to get this knowledge. Okay, let's push down further. Now, so we want to look at tools for economic stability, because as I've earlier said, that the overall aim of any particular country is to bring stability. Sorry, the central bank. That the purpose of a central bank is to ensure that there is economic stability. So they look at the economy, they monitor the economy based on several indicators, And then on the basis of this indicator can draw conclusion on what to do to bring about stability in the economy. So tools for economic stability, example of some of the tools that are used for economic stability by the central bank is interest rate. Now, the central bank use interest rates they use interest rate to control inflation. Whenever they see there is an inflationary pressure in the system, the way to control inflation is interest rate. So if there is inflationary pressure in the economy, what the central bank will do is to actually increase interest rates to bring down inflation. If there is deflation in the system, what the central bank will do is to increase interest rate. Sorry, to drop that interest rate. All right. So they use the concept interest rate to actually control inflation. And what they look at to know if there is inflationary pressure in the system is your CPI, which is the Consumer's Price Index. Number two, tools that they use to bring about stability is called price limit. In the case of price limit, the central bank, in their bid to prevent their currency to become too strong or too powerful, can do a deliberate devaluation of their currency. That is known as price limit. Now, you agree with me that if your currency becomes too strong, it's a problem. And if your currency becomes too weak, it's also a problem. All right? So, if the currency of a particular country becomes too strong, what is going to happen is that their central bank will do a deliberate devaluation by introducing a price limit. Okay, so that is that. Then another way the central bank used to control some things is known as language. They use some certain hawkish or dovish languages to control the economy to ensure to bring about stability. So the central bank uses some hawkish terms, okay, to bring about, if they want something positive, that is, to bring about a boost, and they can use some dovish terms if they want some, there's in the economy to bring it a little downwards, okay? So we have hawkish statements, and we also have dovish statements. What are hawkish statements? Hawkish statements are statements that are positive, that shows that the economy is actually booming, all right? They use such terms actually to control how people feel, to control market sentiment, a feel around their economy and about their currency. So when they use hawkish statements, they are trying to boost the morale of investors towards their direction. And then when they use dovish statement, they try to boost the morale of their investors towards pulling down a little away from their economy or their assets. So their dovish statements, their hawkish statements are statements they use to bring control in the economy. So examples of hawkish statements are some economic growth. These are some statements. If you're listening to Mr. Powell, for instance, during their speech, you hear some terms or some phrases like some economic growth, inflation increasing, reducing the balance sheet, tightening of monetary policy, interest rate hikes. These are hawkish statements. These are positive statements. Okay. So when you're listening to their news, because, when you say, okay, one of the members of the Fed is giving a speech, all right, and you're listening to that speech, these are the phrases you should learn to capture. From these phrases, you will know if what they are saying is hawkish or what they are saying is dovish. So let's look at some dovish statements. Okay, they might also say, all right, dovish monetary statement. Words like weak economic growth, inflation decreasing, increasing the balance sheet, loosening of monetary policy, interest rate hike. These are examples of dovish monetary statements they can make. And when economists hear these phrases, this statement, they understand that what they are insinuating is a negative statement, okay? And that will affect the currency or that particular asset negatively. Is that okay? Okay. Like I earlier said, I want you to just be patient And let's dive into this, because this is actually an exposition, an expository lecture that will help your fundamental analysis. Okay, let's see. Another major or another tool that the central bank used to actually bring about economic stability is known as quantitative easing. Now, what exactly is quantitative easing? Now, quantitative easing is the central bank, upon their observation that there is a scarcity of money circulation in their country or in that economy, they will deliberately print more money to boost money supply in the economy in hope to spur growth. Though in the short term, this might bring about a weakening of the currency, but they look at it in the long term, it will spur growth. So when there is a quantitative easing, is a scenario where the central bank decides to print more money to boost money supply in the economy. Okay, so these are tools that the central bank used to bring about economic stability. Okay, so let's push it down to the next. Now let's begin to look into these indicators, the macroeconomic variables, indicators that the central bank look into, and upon these indicators, the decision they will come at, of which will now result into the fundamental report that we will see in our economic calendar. One of the very powerful economic indicators that the central bank look at is known as inflation. And then we're going to look at economic indicators that tells us about inflationary pressure, if there is inflation in the system. Now, inflation actually is the increase in the prices of goods and services, or the fall in purchasing power. Of course, you will agree with me that once there is a increase in the prices of goods and services, if you're buying a particular goods, let's say for $200, let me use the dollars, okay? And now there's a rise from 200 to 400. If you used to buy 10 of that particular goods, you will buy, maybe you will reduce the quantity you buy because of what? The rise in price. So the rise in price brings about a fall in purchasing power. Is that okay? Now, let's go in for this. What are the economic indicators that shows or that tells us that there is inflationary pressure? Number one economic indicator is the Consumer's Price Index, CPI. We are going to look into more about CPI data, and then we are going to look into it in a full detail for CPI, Consumer's Price Index. Now, you can see why this Consumer's Price Index is a very important data that the central bank look at. It is this data that the central bank look at to monitor inflation in an economy. Now, but before inflation rises, there is an indicator they also look at to forecast inflation, or CPI, and that is known as the Producer's Price Index. Now, what exactly is the Producer's Price Index, and what exactly is the Consumer's Price Index? Let's look at it. PPI, known as the Producer's Price Index. Now, the PPI talks about how much it costs the producer to produce a particular or manufacture a particular goods or service. Of course, you agree with me that if you are a producer, if it costs you more to produce a particular goods, definitely the cost, okay, the price you will tag on that particular goods to the final consumer will also be high. The higher the cost of production, the higher the cost of purchase for the final consumer. So, CPI, what does CPI mean? CPI measures how much it costs the consumer, the final consumer, to purchase that goods or service. Right? So you can see, so there's a correlation between PPI, which is the Producer's Price Index, and CPI, which is the Consumer Price Index. That's why I say that this is a fundamental masterclass, so you just have to stay put. Now, analysis. When PPI increases, it is a signal that CPI will also rise. Is that okay? So if there is rise in PPI, Producer's Price Index, there is going to be a proportionate rise in CPI, which is the Consumer's Price Index. Simple. And of course, PPI results are released month on month. Every month, there's a PPI release. CPI data are released quarter over quarter. Okay? And so that is it. So, but what you're trying to say is that we can decipher what the CPI will look like by PPI, and then we can tell if there's inflationary pressure in a system by our CPI data. So the PPI predicts CPI, and CPI predicts inflation. Now you can see the correlation in this matter. Okay. But there is a CPI targeting. So when CPI rises above the inflation targeting of most central banks, now the inflation targeting of most central banks is 2% or between 2% or 3%. Okay. Now, once it is above this 2% targeting or 3% targeting, the central bank will be tempted to raise interest rate in order to control the inflationary pressure in the system. But if the rise in CPI is still within the band, they may want to maintain interest rate. What's that? And when the CPI is decreasing below the target band, they may want to decrease interest rate. So that is just the concept. All right. So that's the concept. So now you can see that majorly what the central bank does is to bring about stability. So they monitor closely. One of the most important data they look at is inflation data. And the economic indicators that measure inflation are PPI and what CPI data. So that's why these economic indicators are very key. All right. So next time when you hear about CPI data or PPI data, your eyes and your attention, you need to pay attention to these data because they will cause a massive market move in the market. Is that okay? All right. Now let's push on. Let's look at a case study of the US economy. Now, increase in interest rate will strengthen the US dollars. But if the US dollars is strengthened as a result of increase in interest rate, the increase in interest rate will also cause gold to fall, because once there is an increase in interest rate, the US dollar strengthens. And once the US dollar is strengthened, investors will not want to buy gold because gold becomes too expensive to buy because the US dollar is strong. Now, increase in interest rate will also cause the index market to fall. Increase in interest rates will also cause the stock market to also fall. So you can see how this relationship is. Okay, rise in interest rate will increase the value of the US dollar. It will increase, it will cause gold to drop. It will cause the index market to drop. It will cause the stock market to also drop. So you can see why this interest rate data is very key. And then indicators that point to interest rate that will help to bring about interest rate implementation are very key, such as CPI data, PPI data, or inflation data. All right, so let's push on. So let's look at GDP. Okay, because we have looked at inflation, we have looked at our economic data that sponsors inflation, right? Okay, that points to us about inflation. Now let's go to the next. GDP, and our GDP got to do with growth. Now the GDP, it tells us, it measures the overall productivity or the health of that particular economy. How healthy is that economy? That question is answered by the GDP of that particular economy or country. How healthy it is. Is that okay? So I would not want to measure on most of this, but let's just go straight down to this GDP. Let's not push in much on this, okay? So let's just go to indicators that forecast GDP. Examples of indicators that forecast GDP. For instance, if you say the GDP of a particular country is good, what are the underlying indicators that tells us that it is good? Number one, retail sales, purchasing managers index, which is called the PMI, and the fairly fed manufacturing index. So let's look at them closely. Let's increase our pace a little. What is retail sales? Of course, retail sales is a leading indicator. Now, retail sales measures the changes in the price of goods and services bought for household consumption. Okay. Of course, you will agree with me, if the cost of production, that is PPI, is increasing, prices of goods and services will also rise. So people that are going to supermarkets, shopping malls to buy stuff, if they go to the shopping malls to buy stuff, the number of people going there will reduce because of the rise if there is inflationary pressure. And then if at all they get there, the number of goods they will purchase will drop because of the rise in prices. So retail sales measures the changes in the price of goods and services bought for household consumptions. And this make up 70% of most countries' GDP. So how healthy, if you want to know if a particular economy is healthy, check their retail sales. How much of people are purchasing goods and services? If it is on the rise, it means that the economy is healthy. It shows that there is money in the hands of the final consumer to purchase goods and services. That is what they look at. All right, so let's push on. Purchasing Managers Index. Now, the Purchasing Managers Index measures the health of the manufacturing sector. So there we talk about the PMI data. Okay, so imagine a country that their manufacturing sector is sick, it's not doing well. It will affect their country GDP. All right, so because when you manufacture, you can export. Is that okay? The more you manufacture, the more you export. And that will in turn affect your GDP. So this is what we're talking about. So if your PMI is poor, it means that your manufacturing sector is sick. And it means that your GDP is going down. All right. Then the fairly fed manufacturing index. The fairly fed actually is a branch, of a Federal Reserve in Philadelphia. And what they do is actually they bring forth an index. Their index, what they bring forth is a case scenario where we are looking at the economy. This index is such that if it is greater than 0, we say the economy is growing. If it is less than 0, we say the economy is declining. Okay? So this particular fairly fed, which is a branch of the Federal Reserve in Philadelphia, they bring forth this index to see how the manufacturing sector is doing. Okay, so when you look into your Forex economic calendar and you see fairly fed manufacturing index, okay, it's a branch of the Federal Reserve, okay, in Philadelphia, which is conducting based on the index. And the index is that if it is above 0, the economy is growing. Below 0, the economy is declining. Now, PMI values of 42 to 50 is an indication that the manufacturing sector is expanding. A reading below 42 is an indication of a contracting economy. Okay? Now, so you can see the fairly fed index. In the case of the fairly fed index, we have 0, above 0, and below 0. Then we have the PMI values that is used to measure how the PMI data is, okay, if the Purchasing Managers Index is okay or not. It ranges from 42 to 50. So between 42 to 50, an expanding economy. Below 42, a contracting economy. Okay, now, these are indicators that are used to check out the GDP. So when it comes to the aspect of the GDP, remember, we have the retail sales, we have the Purchasing Managers Index, and then we also have the fairly fed manufacturing index. That's it. Retail sales, Purchasing Managers Index, and the fairly fed. Okay, now that is for GDP. Let's analyze it now. If GDP is increasing, it means that the economy is growing, right? Now, as the economy grows, inflation will rise. Is that okay? And as a result of the central bank, we increase interest rate to checkmate inflation. Now, this increase in interest rate will in turn bring about an increase or a rise in the strength of the currency. Hence, the currency becomes fundamentally bullish. So you can see the correlation. Okay? So now, let's push on. I don't want us to waste much time on this. So let's look at employment data. Because I told us when we look at the macroeconomic variables, we'll talk about inflation, remember? We talk about GDP, right? Now, so we have looked at inflation, we have looked at GDP, and the underlying economic indicators that measures it. Now we have come to employment. So now, under unemployment, let's look at the underlying indicators that measures employment. So, number one, we have unemployment rate. Okay? Unemployment rate. Number two, we have jobless claim. 3, average hourly earning. 4, existing home sales or housing statistics. 5, durable goods. 6, non-farm payroll. So let's begin to go into all of this one after the other. Okay, so let's see. Now let's see the case of unemployment rate. Now the unemployment rate, simply everybody knows about unemployment, right? So in the case of unemployment, it talks about the total percentage of persons that are not working, okay? And this is reviewed quarterly. Then we have jobless claim. Now, jobless claim, this deal with the number of people that fills application for unemployment benefits. Now, but this is peculiar to the US economy, all right? Yes, because in the US economy, there is what they call the jobless claim, where if you've lost your job, all right, you will go and fill an unemployment benefit form. And the essence of that form is to enable the US government to have a statistics of unemployed people that they will be paying, pending when they will have a job. And that statistics, they also use it to determine the number of persons or a statistics of unemployed people. Okay, so that is what is known as the jobless claim. Then average hourly earning, this measures the change in employment income. There is a salary. And over there, they are paid hourly. All right, so that is that in US economy. So, all right, so this is average hourly earning. There are some countries that they are not paid hourly. Okay, they are paid monthly or maybe weekly, as the case may be. So that is it. So this has to do with salaries. This has to do with the number of persons that fill in an unemployment benefit form. And this has to do with people that are unemployed. Now, let's see. Now, so you could see when you go to your Forex economic calendar and you look at unemployment rate, jobless claim, average hourly earning, these are employment data. Okay, and we use this to actually analyze how the employment sector is doing. Because if an investor wants to invest in an economy, it checks inflation. 2, it checks their GDP. 3, it checks their employment sector. Okay? Of course, if you're checking their GDP, you will look at their manufacturing sector also. Because the manufacturing sector, okay, is one of the things that influences GDP. Then it will check their employment sector. Now you can see, those are the things they check before they can now say that a particular economy is healthy to do business with. Do you get that? All right. Now, so let's go in for the existing home sales. Now, based on this, we are also saying that if people are working, if there's money in the hands of consumers, they will build houses. They will want to rent new apartments, okay? And then they definitely want to rent new apartments. So the real estate sector will actually be booming. So in this particular case, this existing home sales actually talks about real estate sector. If the real estate sector in that economy is booming, it means that economy is healthy because people are purchasing new houses. Of course, if they are purchasing new houses, what is going to happen? They will purchase durable goods, such as refrigerators, ACs, air conditioner, and air conditioner refrigerators, and maybe TVs, pressing iron, washing machines, and all of this. These are durable goods. So they will purchase all of those things. So you can see the connection. So durable goods order indicator gauges the strength of a country's manufacturing sector. These goods designed to last for 3 years or more years. Why is this data important? When the economy is contracting, these are the goods that the consumer will easily go for. If we want to buy more of daily necessities and car, plane, appliances, etc. Therefore, an higher than expected is positive for the USD. So let's just, well, what we're trying to say is that these durable goods like car, plane, appliances, okay, if the economy is not doing well, people are finding it difficult to eat, they will not be buying these stuffs. What they will be purchasing is more about food items. So if the economy is doing well, people may want to purchase appliances. They want to buy car. They want to buy plane. All right? And all of this stuff. So that's why we look at the durable goods order. These are indicators that we look into to determine if the economy is doing well. Is that okay? Okay. Then the non-farm payroll. Now, the non-farm payroll, okay, we have the non-farm payroll talks about the number of people employed in the US economy, excluding the farm industry. Okay? The number of people that are employed in the US economy, including government employees, but excluding the farm industry. That's called the non-farm payroll. But before the non-farm payroll data is released, there's always an ADP non-farm employment change data that is always released. Like I earlier said, that the ADP non-farm employment change is actually a prelude to NFP, which is the non-farm payroll. Now, this ADP tells us the estimated number of people that are employed, while the non-farm payroll tells us the actual number of people that are employed. That is the difference. So if we can get the estimate, we can, from the estimate, predict what the actual will look like. So that's the difference. Okay. So let's push on further. Let's not waste much time on this. Okay. And then let's go into straight as we begin to wrap up on Forex correlation. Here we want to begin to take a case study of different countries like Canada, Australia, New Zealand, US, China, and they want to take a case study of the correlation between these countries and their currencies. For instance, Canada. Canada is the 14th largest producer of oil. Therefore, the Canadian dollar has a positive correlation with oil. What does that mean? It means that if the price of oil rises, the Canadian dollar also rises. So what we are saying is that the Canadian dollar has a positive correlation with oil. Now, you need to know all of these Forex correlations because it will help your analysis in the market. Is that okay? It will help your analysis in the market. Very key. All right. Now, let's push on further. The Japanese yen. Now, Japan does not produce, okay? Japan has a very little energy production. So they import more of oil. So what does it mean? Hence, it has a negative correlation with oil. What does that mean? Japan will buy more oil when the price of oil is dropping, and less when the price of oil is rising. In other words, the Japanese yen is weak as oil prices rises and strong as oil prices drop. So it has a negative correlation with oil. Do you understand that? It's very key, it's very key, it's very key. Okay, now, look at this. The Japanese yen is also tagged as a safe haven currency. Why? Now, what are safe haven currency? We'll talk about that. A safe haven currency is a currency that investors seems to invest in or safeguard their money into, okay, in order to protect their money as against global crisis. When they perceive that there is a global crisis, that the global economy is not favorable, they will want to push in their money or safeguard or save their money in that particular currency. All right. So such kind of currencies are known as safe haven currencies. Example, the JPY, another example of a safe haven currency is your gold. All right. So that's why most time when you see a global crisis, you will see gold will begin to rise. The reason is that the investors will begin to push their money into buying gold to save their money. So that's why it's called a safe haven currency. So the Japanese yen is also tagged as a safe haven currency. So it is also tagged as a safe haven currency due to the fact that Japan is the world's largest creditors. Therefore, during times of political instability or wars, investors seem to invest in the Japanese yen. Hence, during political instability, the Japanese yen becomes fundamentally bullish. So you can see. So this is what we've known as a safe haven currency. So when there is crisis, global crisis, this currency seems to rise. All right? That's what they're called safe haven currency. Let's look at the Swiss franc, Switzerland. Now, Swiss franc is also looked at as a safe haven currency due to the political neutrality, which means that it rises in terms of political instability. But there is something about Swiss franc that we must harness critically. More than 25% of Switzerland's money is backed by gold reserve. All right? So as a result of that, the behavior of gold in a way also influences the behavior of Swiss franc. Okay? So that is it. So if gold is strong, so does Swiss franc. If gold is weak, so does Swiss franc. Now let's look at Australia and New Zealand dollar. Now, Australia and New Zealand dollar are called commodity currencies. Now, the reason is, why are they called commodity currencies? Now, exportation of agricultural products contributes greatly to their GDP. These currencies are commodity currencies because they share positive correlation with commodities. All right. So, for instance, let's look at this. Both Australian dollar and New Zealand, or Australia and New Zealand, are sensitive to Chinese data. This is because of the close trade relationship between both countries and China. Now, note this. The price of China's product affects New Zealand. And this is because New Zealand exports a lot of their products. Now, New Zealand actually depends majorly on China's products. They export more of China's products. Now, so their currency is closely related to commodities. So whenever the price of commodity rises, these currencies also rises, Australia and New Zealand dollar. When the price of commodities are dropping, this currency also drop. But it will surprise you to know that New Zealand and Australia are dependent on China in terms of their products. So they are called commodity currencies. But there's something about Australian dollar that is very key. That Australian dollar has a very strong positive correlation with gold because Australia is the third largest producer of gold. So if gold is rising, check Australian dollar. So whatever happens to Australian dollar will also affect or influence the behavior of gold because it is the third largest producer of gold. All right, let's push on further. Let's quickly look at US and China trade relationship. Is that okay? Now, China is dependent on US economy. US buys, they export about 21% of their products to US. So, or US buys about 21% of China's exports. So you can see that US are like their major buyers. So whatever happens to the relationship between China and US is going to affect China's economy a great deal. And if it affects China's economy, it's going to affect New Zealand and Australian dollar economy as well. You can see the connection. Okay, so if China's economy is weakening, it will affect importation of oil. Hence, the global oil demand will drop. And this will in turn affect the Canadian dollar because Canada is dependent on oil. The Canadian dollar is dependent on oil. So If China's economy is weakening, it will affect the global demand on oil, and which in turn affect Canadian dollar. If China's economy is weakening, it will also affect Australia and New Zealand. So you can see the connection in this particular theory. All right. Again, it will also affect the importation of iron ore from Australia because iron ore is one of our exports to China. So Australia exports iron ore to China. So you can see that China is a very key, sometimes it will surprise you that country like China, it will not be surprising if China in years to come becomes a world power. You can see the dependence on China, but China exports, but they are still kind of dependent on US because they export about 21% of their exports to US. Is that okay? All right, so let's push on. Let's look at gold. We are gradually wrapping up. We just have some few minutes and then we are done. Okay, gold. Now let's see. Gold is actually affected by inflation. Gold is seen as an edge against inflation. By that we mean, like I've earlier said, gold is seen as a safe haven currency that investors actually wants to invest in gold during a time of uncertainty. Okay, global uncertainty. Investors want to push in their money to buy gold. Okay, so that is why gold is seen as a safe haven currency. And we are also, based on our analysis, based on what we have studied so far, we are seeing that once there is an interest rate cut, gold will rise. But if there's a rise in interest rate, gold will drop. Okay, we have seen that earlier. And then the value of dollar, when the value of dollar rises, increases, gold becomes too expensive to buy and therefore drops. Okay, so that is what happens whenever the interest rate rises. Okay, that's about gold. Then we also have risk. Risk on. There are sometimes in the market we have a risk on mode and then we have a risk off mode. Now, what do you mean by risk on? A risk on is a case where the global economy is perceived to be expanding. The global economy is healthy to trade. So investors are willing to take more risk because the global economy is healthy. Okay, it's expanding. Okay, so they kind of push on, their risk appetite is on the rise because of how healthy the global economy is. Then we have also what is known as, there are certain financial instruments they buy whenever they perceive this, and they include stocks and the commodity currencies, all right? So commodity currency, now you understand what we mean by commodity currency, like Australian dollar and New Zealand dollars are called commodity currencies, okay? So during the risk on mode, whenever they perceive that the global economy is healthy, this currency seems to be rising. Australia dollar and New Zealand dollar and the stock market. Is that okay? Now, the other one is called the risk off mode. This is the reverse of the risk on, when they perceive that the global economy is not healthy. Okay, so investors contract. They kind of retrace their steps. They don't want to be taking much of risk. Okay, and so what happened in that case that they seem to push in their money to safe haven currencies such as gold, the Japanese yen, the Swiss franc, and bonds, government bonds. Okay, so these are the things that they do during a time when they feel that the global economy is not healthy to invest. Okay, so finally, here comes the economic calendar. So just as I've earlier said, that now, after all this analysis, the central bank will now put forth what is known as a risk event, which is scheduled to be announced at a particular time. This is what actually comprises our economic calendar, that we'll now look at when the central bank of each nation wants to make the announcement, fundamental announcement, on the basis of their economic indicators. They have gathered information and then they have come to a conclusion to give an announcement, and then this announcement will drive market sentiment and eventually will push on and will determine the market direction. Okay, so the economic calendar actually displays the scheduled release dates of information related to the economy that significantly impacts the financial market. It entails economic reports and information for specific countries. And so how does Sources, where can you get these economic calendars? You can get them from Daily FS Forex calendar, from Forex Factory, FS3 economic calendar, several economic calendars you can actually look into to check out on a daily basis what the market is saying or the news that is scheduled to be announced. Okay, so these are different. We have Forex.com economic calendar, BBP's Forex economic calendar. Okay, so many economic calendar you can talk about. All right. Now, this is the Forex Factory economic calendar. And then if you're using the Forex Factory, you can see that the Forex Factory economic calendar, we have what is called the actual, we have the forecast, and then we have the previous, okay? And then we also, perhaps you may be wondering, what are these colors for? The orange color stands for medium impact news. The yellow color stands for low impact news, and the red color stands for high impact news. Like today, we have the what's known as the consumers confidence, by 3 p.m. All right, so that is it, and then it goes on that way. So that is that. So this tells you that this is an high impact news, this is a low impact news, and this is a medium impact news. The high impact news actually cause major movement in the markets. Medium impact, kind of a moderate move in the market, and the low impact may have little or no movement at all in the market. So that is it about the Forex economic calendar. All right, so ladies and gentlemen, this is how far we can go concerning our fundamental approach to Forex. Now you have an idea about what a fundamental analysis is and the various economic indicators that this what's it known as the central bank of each nation looks into before they bring forth their fundamental report, and how you have also seen the correlation of different nations and how they are related together. I guess this will help your trading career and boost your directional bias and your judgment on which particular asset to trade per time, which will eventually boost your success rate in the market. Thank you so very much, ladies and gentlemen. See you once again, same time, some other time rather, where we're going to talk about more detailed things about the financial market, just like this, same time next week, Tuesday. I want to see you on the next lecture. Stay put, and don't forget, this is brought to you by DB Investing. Bye-bye.